Good afternoon, friends. So welcome to this Emkay Media Roundtable banking sector webinar. So we have today Anand Dama, our head of banking sector research, and this cover that you see on the first slide is actually cover of his latest report, the excerpts of which and the analysis of which he'll share in this webinar. And eventually, we'll give you a press release and the report as well. So without further ado, I'd like to hand this over to Anand, who can take this ahead. Anand?
Yeah, hi friends. This is Anand Dama from MK Global. I head the BFSI sector. Welcome you all. So basically, as Amit has already introduced, was basically the topic of this report. I think it is a very, very pertinent and important topic that that the entire banking sector is now currently struggling with. When you look at the investors also, they have been asking this question. And if you look at basically the overall banking sector credit growth at this point of time, is somewhere about 21 odd percent. If you include the HDFC Bank's growth, obviously there is a base effect where because of which this growth is what we're seeing at this point of time. But if you look at the deposit growth, is still lackluster at somewhere about 13 odd percent, and because of which the LDRs have shot up, even leading to some RBI nudge to select banks that they need to bring down the LDR. From the investor perspective, the bigger question that we face continuously is that the cyclical slowdown that we have seen in the deposit growth for past 5 to 6 years, where the deposit growth in most of these years, except for the demonetization, has been sub 15%. Whether this could actually become a structural risk to the overall credit growth in the long run as such. So in this report, we have actually tried to put out these questions, discuss about what are going to be the structural concerns that we see going forward, and what could be the possible solutions. And again, who are the basically banks who are actually working on these solutions at this point of time, and ultimately who will be the winners either in the near term and in the long run. That is broadly the question that we are trying to answer over here. So as I said, basically, if you look at the storing charts, if you look at the LDRs, somewhere in FY24 are expected to somewhere about 79-80%. If you look at the last 50-year data as such, long back in early 60s is when basically we had almost about 78% kind of an LDR. So for the system as a whole, we have never ever seen this kind of LDR. As I said, this is partly to do with the HDFC Bank. If you take out the HDFC Bank and HDFC Limited merger, still the LDR are at least about 78 to 77% as such. And now this LDR certainly seems to be higher and has already attracted the RBI's nudge. And that is the reason there is a lot of question that basically whether the current liquidity tightness could actually lead to faster contraction in the margins that we're going to see in the near term. So the answer to that question is that we believe that the current liquidity tightness that we are seeing, it is more to do with the RBI policy action. And if you look at again in terms of the deposit growth, it is already picking up closer to about 13 odd percent. As far as the interest rate cycle is concerned, most bankers were actually expecting that the rate cut cycle would start soon. RBI would cut the CRR, pass on the liquidity, and that be the case. They need not really push hard for bulk deposits or increase the rates. But I think the reading of the cycle across the board, I think, has gone wrong. And now banks are actually forced to raise deposit rates. And if say for instance, basically any private bank is not raising deposit rates, then obviously the deposit growth will not come, and ultimately they will have to sacrifice the credit growth. This problem that we're talking about, I think it is more prominent for the private sector banks than the public sector banks, and this is again possibly going to get manifested through most of the private sector banks, and particularly HDFC Bank if you look at. Yeah, so if you can see basically the LDR across banks, HDFC Bank has one of the highest at about 110%. And then you have IDFC, Axis. Most of these banks have a higher LDR at this point of time. Amit, you can move to the next slide. So basically, this is basically what we're talking about, the near-term problem. Now, when we talk about the longer-term problem, so what basically the investors have a question is that the current slower deposit growth, whether it will ever cross 15% or not. And actually, there are a lot of macro and the micro variables where there are some structural risks that we see. So one important question which again arises is that over next decade, if you look at the retail credit growth, obviously is going to be stronger, because if you look at the consumerism in the Indian market, certainly is on a higher side, and obviously that would mean that the retail credit growth will continue to be on a higher side, be it for the commercial retail or be it the personal retail as such, like unsecured loans, credit cards, or for that matter, commercial vehicle financing, lab and such. So obviously banks would want these loans to be funded by the retail deposits as such. If you recall, in early 2000 and so on, when the infra growth and the corporate credit growth used to happen, banks were happily ready to take short-term deposits or bulk deposits or the corporate deposits as such, even at a higher rate, and fund it through the basically those deposits, which actually were certainly costly and were short-term in nature. So banks were actually funding the long-term assets with short-term deposits, and we know that that basically led to the ALM risk, and ultimately that to some extent manifested when basic into the AQR exercise by RBI, and then we had a long NPS cycle, and then basically the deposit growth, credit growth both collapsed over about 5 to 6 years. We believe that if next 10 years or so, if the retail credit growth is going to be stronger, obviously bank would not want to repeat that mistake, and they would certainly chase for higher amount of retail deposits. And if you listen to the commentary of most of the banks, they are clearly saying that the credit growth over next 10 years as such, or the asset growth will be more driven by the liability growth. So if a bank doesn't have a liability growth as such, certainly they will have to sacrifice the growth. And if they're not ready to sacrifice the growth, then they will have to sacrifice the margins and ultimately have an impact on the ROA. So we believe that most of the banks are going to go whole hog to mobilize retail deposits as such. So this problem basically is known. Now we believe that what are going to be the solutions for these problems. So when we look at the macro levels, so GDP growth, certainly nominal GDP growth, if you look at currently is hovering somewhere about 10% 9.5 to 10%. We believe there will be some improvement in that by about 100 to 200 basis point over next 2 to 3 years, and hopefully that should sustain going forward as to some extent the inflation does moderates, and the real GDP growth remains somewhere about 6.5 to 7% as such. So that certainly would provide some support. We also expect some support coming in from the money supply side, because for some time, basically the money supply, the M3 growth, if you look at, has been relatively lower. That has already started picking up. The lag impact of the credit growth that we have seen, that should also be seen, particularly in terms of the better M3 growth. And we expect at least in next 12 to 15 months, RBI would certainly ease the liquidity in the system. They might even go for, to some extent, cutting the CRR. So they would also, to some extent, improve the M3 growth as such. So therein, we will have some support. Apart from that, if you look at the real interest rate as such, that's again being a bigger problem, particularly because of the higher inflation. If inflation does ease to some extent, I think we will be in a positive territory as far as real interest rate is concerned, and that would also support the deposit growth. These are macro factors as such, where we expect some improvement to happen. Now we look at the micro factors as such, micro variables. We believe that yes, digital is must, but branches have their own importance, and this is what we have seen in foreign countries where a lot of digital banks actually open branches, because without which ultimately you not be able to source deposits, or even if you source deposits, the deposit will actually not be that sticky. So globally, I think the importance of branches, even in the current digital world, is well known. Back in India, it is far more important. Even if we basically do not tend to go to branches very often, because we transact digitally, I think we still need a branch around us. And at times, basically, our preference also for a bank goes on based on whether there is a branch nearby as such or not. So this is basically true for the digitally savvy customers. And obviously, if you look at the older age people, certainly they would want to go to branches. And there is a bigger change which has happened in the way basically branches are now organized. So earlier, basically, branches were predominantly a source of, just sourcing liabilities as such. Now, branches also, to some extent, source your fee income through TPD businesses and other businesses as such. And they also become, they also be part of the hub and spoke model, where your retail asset centers, to some extent, are controlled by the branches and such. So branches have their importance, and we believe that going forward also, the branch expansion will be very, very important. And in this chart that we see in the Exhibit 6, we here established that there is a strong correlation between the branch expansion or even contraction, and in terms of deposit market share. So clearly, if you look at over the years, public sector banks have seen contraction in the branches to some extent because of the overlap which was there post the merger, which they have actually tried to cut it down. On the other hand, basically private banks were adding branches. But when we look at the data, Amit, can you just move on to next slide? But when you look at the data for past decade as such, the branch expansion, particularly for last 5 years, has been predominantly been done by the private sector banks as such. And these branch expansion, again, if you look at, there are some banks like Axis Bank and all, who are the one basically who have added branches. Yeah, you can move to next slide. Yeah. So if you look at RBL, IndusInd Bank, HDFC Bank, Axis, ICICI, these are the one basically who have added branches in last 5 years or so. Whereas the other banks like Kotak and all have not been that aggressive in terms of adding branches as much as what we see for the other banks as such. And we believe certainly this will have an impact from a long term perspective in terms of deposit mobilization. One very interesting analysis that we have done over here is that if you look at the need for branch expansion over next 4 to 5 years, we believe that it is going to be at least somewhere about 20,000 odd branches that the banks will have to add. Uh, um, this obviously will have to be supplemented by the other strategies like focusing more on the self-funding ratio. If you look at presentations of most of the banks now, they talk about the self-funding ratio as such. Self-funding ratio is a ratio where basically if you lend to a corporate or to an SME, say for instance, you try to mobilize deposits from the entire ecosystem of that SME or a corporate as such, be its employees, be the relatives of that corporate, I mean, the individual as such, the board members, the current account flow, the entire transaction flow is what you try to capture. And you, in a way, basically try and look at that self-funding ratio. Wealth management also has its own importance, that basically these services can be offered from the branches. And we believe that, based on our internal survey that we have done in the past, banks or the branches basically who have wealth management centers in the branches, certainly there are more walk-ins that you see into those branches. There is more engagement that you see into those branches as such. And obviously, ultimately, that leads to some kind of deposit mobilization as such. No, basically, there is a clear correlation between branch expansion and deposit mobilization that we have talked about in this report. As I said in the beginning of the call, that if the deposit growth doesn't picks up, uh, uh, obviously in the long run, the banks either will have to sacrifice growth or will have to sacrifice margins. The margin contraction that we are seeing in FY 25, 26 as such, it is more to do with the cycle effect as such. But as I said, these structural risks do emerge. I think we can see even far more margin contraction in the long run for the banking sector as such, and that is a bigger concern that we see. Uh, Again, as I said, that we expect, we believe that bank need to add at least about 20,000 odd branches over next 5 to 6 years. There again, it will have its own cost. So basically, the OPEX certainly will remain higher for these banks, and we expect that at least for some of these banks, this OPEX could be higher by 10 to 20 basis point, depending on what kind of branch expansion that they do in the interim period as such. So certainly, it all would depend on the kind of branch expansion that the banks are going to do. This, if you look at the OPEX of the Axis Bank, they have been adding branches, and for past 2 3 years, their OPEX has been on higher side. That is what is already reflecting. In case of HDFC Bank, we're already seeing that they have started adding branches, and the cost is certainly going to be on a higher side. So this is basically an investment that these banks are making so that they will be able to sustain higher growth in next 10 years or so. Uh, Obviously, it will have an impact on the ROEs in the near term, but we believe this is a good investment that these banks will actually make from a longer term perspective. Now, one question that a lot of people ask, that what is wrong with offering higher rate rather opening branches? Obviously you can offer higher interest rate as such and attract a customer and mobilize more deposits. This to some extent works in the near term, and again, this to some extent works into some of these metro or the customers basically who are interest rate sensitive as such. But then there are a lot of customers who are not that interest rate sensitive, and when basically the interest rate cycle does reverses, or if you cut down the interest rates, obviously your deposits will fall. So I think the permanent solution is basically that the banks need to add branches. And ultimately, whoever basically at this point of time is offering higher interest rates and mobilizing deposits, at some point of time, they will have to reverse this strategy. If they do not, then certainly they will suffer in the long run as such, because their cost of funds will remain higher, and they will not be as competitive in the market, because obviously they will have to pass it on to the lending rates, and they will not be competitive as such. And that would either impact their margins, ROS, or obviously the growth. So we believe that expansion, branch expansion, and more so that investment at this point of time is going to be very, very critical to ensure that the retail credit growth bandwagon that we are talking about sustains in the long run as such. This is basically the ROE trajectory that we have shown. And this is again more from the investors' perspective, that we believe public sector banks, if you look at their CD ratio, the LDR is relatively lower. They are comfortable in terms of liquidity. They'll be able to sustain the growth that they are reporting at this point of time. Valuations are favorable for them. They are looking at ROAs in excess of 1%. Their margins, we believe that the contraction will be on a lower side versus the private sector banks. We expect when the G-Sec yield does corrects, obviously these banks will report better treasury gains. Apart from that, we have seen higher OPEX for some of these public sector banks in FY24 because of the wage revision. Next year, again, they will get the base effect benefit as well. And add to that, the corporate asset quality is still holding up well, and there are a lot of resolutions which are in the pipeline, which means that we believe the ROIs of the most of the banks are going to be in excess of about 1% for good time to come. Again, if you look at in case of the public sector banks, there is a decent re-rating which has happened, but they are still trading below the long-term averages, and so there is still scope for better re-rating. Along with that, there will be an earnings growth that we expect for these public sector banks. So as we speak at this point of time, we continue to like public sector banks as a pack, and within which obviously Indian Bank, Canara, Bank of Baroda are our top picks, apart from SBI as such. Then when we look at the private sector banks, there again our preference is primarily towards the banks that ICICI Bank, Axis, IndusInd Bank, HDFC Bank, who are investing into the branches at this point of time. And we believe these are the banks certainly will be able to survive and thrive in the retail deposit war that we're going to see over next 10 years. But yes, there will be a cost that they will have to incur in the near term to medium term, that to some extent will have impact on the ROAs. They will have to find avenues to offset this cost increase which is going to happen. but certainly this is a good investment that they will have to make for the long term benefit as such. Yeah, with that, basically, I'll rest my case. If you have any questions, we are open for Q&A session. Yeah, so if anyone basically has a question, they can raise the hand and ask a question. Yeah, I think first question was from Pushpita. Pushpita, you can ask a question.
Hello, sir. Am I audible?
Yeah, Pushpita. Yeah, now you're audible.
I'm so sorry. Sir, thank you so much for the presentation. I mean, thank you so much for this data. I just want to get some understanding on the side of the payment bank. So you spoke about the PSUs and the private banks, but also on the deposit side, we have seen that payments bank have been struggling. And after, I mean, not specifically focusing on Paytm payment bank, but it has been a decade. Payment bank has been in function, and it has not been a success story so far. So, what would be your opinion on why the payment bank is also struggling with the on the deposit side, and what are the challenges they face, and what how they could address it? If you could please share your views on the same.
Sure. See, if you look at, I mean, not speaking specifically on Paytm, payment bank model per se, if you look at, has not picked up primarily because there are no avenues of generating revenues for them. And
Hmm.
obviously, if you do not have avenues of revenues, then you'll not be able to offer finer rates to the customers.
Hmm.
And payment banks, specifically, if you look at, are mainly the banks where basically who try and capture the customer transaction flow, and from there, basically, they try and mobilize deposits. Right. If you look at the most of the, I mean, I think about 10 to 11 licenses were given. Of that, I think 5 to 6 players already surrendered their
Yes,
payment
sir.
banking
Out of
license.
11, 6 of them surrendered or they were shut down
Yes.
eventually.
Because the model itself is not self-sustainable. Secondly, again, it's all about the perception.
Hmm.
So if you look at a universal or a scheduled commercial bank, obviously has far more basically appeal to the customer, where basically you and me are basically going to park money. That I think appeal certainly the payment banks do not have as much. And secondly, also that if you look at SFB, small finance bank, they also to some extent struggle
Hmm.
for the low cost deposits again, because of the perception that the customers have. So these banks obviously have to offer higher interest rates. Now SFBs to some extent can offer higher interest rates because on the lending side, they can make good money because most of these players, except for I think AU, has a microfinance portfolio where they earn decent yields, and because of which they are able to offer higher interest rates. But
Hmm.
that is not true for payment banks, and I think that is the reason they are struggling, and I think incrementally they are going to struggle more as such. That's also a reason why recent piece that we had written, where we suggested and we believe that RBI certainly is going to come up with a digital banking license, and where basically you will have a lot of these fintechs converting themselves into a digital bank as such whenever that license is going to be open. Obviously, first stage is that RBI is going to issue draft guidelines, and then we will have final guidelines. So it's a long drawn process. And secondly, RBI has also provided an option to a lot of these payment banks to convert themselves into small finance banks. I think already, if you look at Fino Payment, is in the process of applying for a SFB license.
Yes, sir.
So payment banking model itself is what I believe is not that great to have.
Got it, sir. So, sir, as you mentioned, so to cope up with this thing, so as you mentioned that for to go for the small finance bank license, so do you think that is the only way out for them to make themselves sustainable because they are not able to generate revenues in this current model?
So if you look at a bank like Fino Payment, it does generate revenues. There are ways of doing that. But if you want to build a scale, ultimately, that under payment banking model obviously is going to be a question as such. So you need to have a unique model altogether to generally, really make money into payment banking model, which I believe that Fino Payment to some extent was successful, but building a scale again is going to be a challenge for them. So I think that is the reason why they also would apply for, I think, the SFP license.
Got it, sir. Thank you so much, sir. Thank you.
Thank you.
Hello. Hi, Anand sir. This
Yep,
is
yep, Pragati. Yep.
Pragati. Yeah. Sir, I have two questions to ask you. One, I want a clarifier. You said that the need for branch expansion is expected to be around 20,000 odd branches. Is it for public sector banks or private sector banks, or and
We,
for what period?
sure. So we just talking about the entire system, and when we are saying that they need to add about 20,000 odd branches, it is basically our estimation
Okay.
that if basically, say for instance, if they need to really mobilize deposits at a higher rate and sustain credit
Hmm.
growth, then this is what they need to do. Now
Okay.
there are other avenues.
Hmm.
In a way, basically they can still mobilize deposits through BC model,
Hmm.
which is again a good model that a lot of banks are working on rather than opening an entire branch altogether.
Hmm.
They mobilize through BC model. They have these partnerships that they have basically entered into,
Hmm.
and that is how basically they try and mobilize deposits. But
Okay.
our projection, so basically it's not a hard punch number that
Okay.
20,000 is the number that basically banks will have to. But if you
Hmm.
look at a lot of banks, like HDFC Bank has talked about adding about 1,500 branches per year.
Hmm.
Obviously, ICICI Axis Bank is going to add lower branches, but you can expect them also to accelerate branch expansion. And PSU banks, particularly if you look at, have not added branches for past 5 years because of
Yeah.
the merger
Yeah.
banks and all. And they are also now started looking at any gray spaces, white spaces which are there where they would want to open branches as such.
Okay.
So it's for the system as a whole and not necessarily that they're going to add these 20,000 branches in next 4 5 years only. I mean,
Acha.
they can always
Okay.
spread it out. They can have bundling up in few years as such.
Okay.
So that is how basically we look at it.
Got it. And so my second question has to do with some asset quality concerns in the credit card portfolio of the banks. Are there concerns in the asset quality, or is that something that needs to be monitored? And where would ideally the stress be if there is? Is it like the new to credit customer, or is it the personal loan on credit card? If you can help me understand that bit as well.
Sure. So if you look at the current NPS that we have seen in the credit card, it is more of a, I mean, partly obviously it is because of the normalization cycle.
Hmm.
When I say normalization cycle is that, post COVID, we had seen higher NPS, then it came down, you had a lot of recoveries. Then basically, obviously, for some time, the credit card book did not build up. And then again, after that, basically, we have seen a sharp growth in credit card. Now,
Hmm.
there is some seasoning of this book, which will happen, obviously,
Hmm.
and will lead to some delinquencies, which will certainly shoot up.
Hmm.
Secondly, if you look at the revolver book, is still far lower as compared to what it used to be there in the past.
Hmm.
So banks or basically the lenders, to some extent, obviously have cut down the revolver book as
Hmm.
such. Third, if you look at a lot of card players have actually focused on the PLCC as a product, that is personal loan
Yeah.
and credit card, right?
Hmm.
Now that personal loan credit card, to some extent, it is slightly different as compared to the EMI card portfolio that you have.
Hmm.
And that to some extent, I believe is that could be posing some risk
Okay.
as such, because that obviously increases the overall customer leverage. There are a lot of multiple loans which have been given.
Hmm.
I think again, and basically a lot of card players have actually gone into tier two, tier three cities,
Hmm.
where even the customer really doesn't understand the risk of the card, and the basically ultimately to some extent he gets into a debt trap.
Yeah.
There are some pockets where basically there have been a stress as such. So I think it is cumulative factor of that
Hmm.
which has led to these kind of NPS. Do
Okay.
we expect a blowout scenario anytime soon? The answer is no, at least for now.
Okay.
I mean, based on what we see on the ground.
Hmm.
But whether the NPS are going to go up, the answer is yes.
Okay.
Where it will settle, it is very difficult to say. And I think you've already seen RBI taking a proactive action.
Yeah.
When they saw some noise on the ground, I think they've already taken some proactive action where they've
Right.
already increased the capital requirement for a card.
Right.
Yes.
Okay. But sir, personal loan on credit card is anyway given to vintage customers, yet we are anticipating a risk over there.
See, what happens is that, I mean, even if you are giving out to a vintage customer, ultimately his debt on the hand certainly goes up, right?
Hmm.
And we don't know basically what is the purpose of this PLCC, where he has basically used it.
Okay.
As such.
Hmm.
EMI is a, as I said that basically you have revolver, then you have EMI book. So EMI book typically is for any white good purchases or, any travel that you would have done and basically converted into EMI and so on.
Hmm.
But PLCC is what you take at one go,
Hmm.
which is sizable, obviously, as compared to the EMI products that you typically take or the
Hmm.
EMI loan that you take. And it could lead to a debt trap for some of the customers, even if they are vintage customers as such.
Okay.
And
Got it.
if basically they would have had their earning loss as such, then obviously it can lead to higher NPAs.
Okay. Got your point, sir. Thank you so
But
much,
there
sir.
is no data to say that, PLCC is
Yeah.
the book where basically we have seen higher NPAs.
Hmm.
But, this is what we believe is showing up. So,
Acha. Okay. Got it, sir. Thank you so much.
yeah. Yeah, Shobna, you can unmute yourself.
Yeah. So, in the near term, where do you see deposit rates? I mean, do you think they will edge up a little bit, or you think the banks can manage at these levels? Because while I buy your point about, over the longer term, they'll set up the branches, etc., and mobilize deposits, that will take time. So, where are you seeing, say, term deposit rates, say, in the next 6 months, 8 months, or, whatever point you have visibility?
Yeah. So if you look at most banks, if you look at in last 2 to 3 months, again have raised the deposit rates because I think everybody has now sensed that the rate cut cycle is going to be certainly an extended one. Uh, and right now we are seeing liquidity tightness in the system. I mean, you can see the RBI data. And in fourth quarter, typically being a busy season for the banks in terms of credit, I think they are even going for bulk deposits, which are somewhere about 70 to 80 basis point higher than the rack rate for retail TD as such. So I think banks have already raised rates. The effect of that, obviously, you will see in the cost of funds in the times to come as such. Do we expect meaningful jump up in the deposit rates from here on? Looks unlikely because we believe that once we are through with the fourth quarter, maybe first quarter again will be relatively slower in terms of credit growth, and therein the liquidity requirements obviously will be on a lower side. So in the near term, we do not expect a significant increase in the deposit rates as such. But again, it all depends on how long the liquidity tightness continues, how basically, I mean, when basically RBI is going to cut rates. So I think till that time, the rates will remain elevated, even if they do not go up from here.
You know, how are you so confident that the increase in liquidity as and when it happens? So the incremental, you know, amount of that will go into deposits and not into competing instruments, whether it's, other government savings, which is what has been happening, other products, whether it's even equities, um, you know, and the fact that although you're right that the loan growth will slow, do you think that that incremental amount of deposits the banks will be able to mop up? Because the LDR, like you pointed out, is already high. So that's also a point that they will bring it down. So they will require less. What makes you so confident that, like in the beginning you said, there's a structural change in um, this whole deposit mobilization where the households are parking their surpluses.
Sure.
So what is giving you the confidence, especially since you're saying that the rates won't go up and it's a taxable product?
Sure. See, I think you have to divide this into two parts. One is what we are talking about is a near term as such, and then again we are talking in the long run. So I said that near term, obviously, deposit rates are unlikely to go up really meaningfully because as I said that from first quarter onwards, obviously, you will expect some liquidity to ease out. Once elections are over, again, the government, which is holding up a lot of payments, I think would release and would supply back the liquidity into the system. And I think RBI would also do its own bit in terms of supplying the liquidity, and that will ease out. The question which you asked about the substitution effect is what we call in a report also, is that money moving into equities and all. I think there is an RBI paper also on that, and we've also talked about in detail in our report that substitution effect doesn't really have a meaningful impact on the overall money supply or deposits as such in a way, because when you park money into equities, certainly it goes with some corporate or maybe somewhere it remains into the institutional
Yeah.
deposit flow. So when you look at from the macro perspective and the overall deposit flow, it is still there, right? Somewhere
Yes,
in
yes,
somebody's account there's a
yes,
deposit.
absolutely.
And that's the reason we have highlighted in our report also that it doesn't leads to a deposit leakage in an overall structure.
Sense.
But yes, it does leads to a retail deposit leakage,
Yes,
right?
yes,
Because it goes out
yes,
from
yes,
your account and basically
into a
somewhere for
corporate
some time
account,
it gets parked into the
CASA.
institutional deposits as such. So retail deposit leakage certainly happens, and yes, this is one concern which is there from long-term perspective, which is going to happen. I mean, very interesting chart here we were put out into our report also, where the SIP flows, if you look at, have been significantly higher
Yes,
as a percentage of deposits in our report. So that is, yes, more a structural concern that we see. Now, as I said that from bank's perspective, if you look at the choice is that they add branches or keep the rates higher. So even if basically we have a low, I mean, we will have at some point of time rate cuts happening, and obviously banks will cut down the deposit rates as such. But if the bank do not add branches and they do not get as much of deposits as they want, the fall in the deposit rates will be slower, or it could be lower for some players. Some players would just still hold on to higher deposit rates to some extent. Obviously, it will be lower than what we are seeing now. But in the cycle, if you look at whether it will go back to the earlier levels of about 5-6% as such, may not happen. For select banks, it could still be higher than what they would have otherwise had it, because they would have a deposit problem as such. So that is what we are saying from a long-term perspective, is that structurally, if these problems do sustain, then if the deposits flow do not come through the normal route, then banks will have no choice but to keep the rates higher as such. So deposit rates would come down from the current levels, but it will not go back to the levels where from it started.
thanks.
Yes, Srivats Krishnaswamy, yeah, you can unmute yourself.
Yeah, hi. Hope I'm audible.
Yeah.
Okay. So thank you for the presentation. I just had one query. Is there any visibility on by what extent are the public sector banks likely to outperform overall profits this year vis-a-vis last year, given the pressure on deposits?
So, again, we clearly said that as far as public sector banks are concerned, I mean, liquidity is not a big issue. And that's the reason we like public sector banks in the near term. And if you look at our report also, we have clearly said that LDRs are lower, the LCRs are better. In fact, their retail loan to retail deposit share, which is a very interesting data point, is far lower as such. So they are not as stretched for liquidity as much as basically private sector banks are concerned. Now, public sector banks, I mean, obviously last year, if you look at just profit growth, obviously was higher because of the base that you had. I think as the base comes in, I think the overall profit growth will come down. But still, we expect public sector banks to report at least 18 to 20% kind of a earnings CAGR here. Point here is that a lot of public sector banks are also going to raise capital. They have raised capital, and some more will raise this year. And we believe that earnings growth being reasonably strong, certainly these public sector banks will be able to raise capital at a decent valuations. And notably, if you look at a lot of these banks are now trading at more than book value, which is a positive sign for these public sector banks, because they will be able to raise capital at a better than book value, or at least at book value, which was not happening earlier on. So in fact, any capital raise that they're going to do, actually, it's going to add to their net worth, add to their book value as such, which typically happens with a private sector bank. So I think all things seems to be pretty favorable. for the public sector banks in general. And I think at least next 6 months, we believe that public sector banks will continue to do well. We do not see any concerns emerging for them, except for one thing which we believe, which is largely known to the market, is that RBI at some point of time is going to come up with the ECL norms, which is expected credit loss norms, and that to some extent is going to have a impact on the capital for the public sector banks. It's not going to hit the PNL. It's going to largely hit the capital. But I think again RBI is going to provide at least for 5 years for them to take the hit on the capital, as and when the ECL norms do come in. But otherwise, yeah, we do not see any major risk for the public sector banks. One, in terms of profitability, as well as in terms of the stocks.
So, if I'm right, last year public sector banks had a record profit of more than 1 lakh crore. So, going by your metric of a 20% CAGR, the overall profit should be at least 1,20,000 this year.
I mean, that is basically up to you to basically work out. But yeah, we believe that.
But do you have any research or a forecast on that?
See, basically, because we do not cover the entire PSU pack. So we have about 5 to 6 banks under coverage. So it is not possible for me to guesstimate basically what's going to happen of that 1 lakh crore. But what we are saying for the banks that we cover, we expect decent earnings growth at least in the near term as such, at least over next 2 years.
So your coverage universe is the top 5 banks or
top 6 banks?
Top 6 banks.
Yeah.
So in that universe, you expect a 20% CAGR.
Yeah.
Got it. And one small second question, if I may, how do you see the treasury profits to pan out in the March quarter, given the way yields have moved?
See, this quarter, I mean, obviously we are not expecting a major, treasury gains to flow through. I mean, there are still about 9 odd days. We don't know how GSEC yield movement is going to be as such. But we are not building in big treasury gains in this quarter. And you also need to see that, GSEC yield has 2 to 3 impacts on the earnings of public sector banks. So obviously one, as the GSEC yield just falls, they will have better treasury gains as and when, they tend to sell their AFS portfolio. But come next year, that is from 1st April 2024, the new investment classification norms are going to come, where the mark-to-market losses which the banks used to flow it through the PNL, they will have to adjust it through the AFS reserve as such. So I think the earnings volatility for public sector banks also is going to go down from next year. So notional losses which they used to book through the PNL, I think that will happen now through the reserve rather than hitting the PNL. So that is one positive, is also what we are looking at as far as public sector banks is concerned from next year onwards. Secondly, the impact of GSEC also is also to be seen through the employee cost, because as the yields do come off, obviously the retirement liability of the banks does go up, because the investment that they make to fund this liability obviously earns relatively lower interest as such. It will also have some impact on the margins. So it's not one way street where the GSEC yields fall and basically banks tend to make higher treasury gains. They also need to make higher retirement liability provisions. And again, the margins also to some extent take hit. On net basis, it will be positive. But I think nothing specifically that we believe is going to happen, at least in this quarter.
And so the overall banking system credit growth, I may have missed that number. What is it that you're expecting?
So this year, obviously, it will still be about, we're already seeing the recent numbers which were there about 16.5%. If you exclude the HDFC Bank, and if you include the HDFC Bank, HDFC Limited merger, and without taking that into the base, right, it's somewhere about 21.5%. So we believe it should remain around that level. But as we progress, maybe in FY25, we expect that to come down to somewhere about 11 to 13% as such. So broadly, for next 2 years, we expect credit growth somewhere between 12 to 13% or so.
So when you said 21%, it is for the entire banking system.
Yeah, so that basically RBI reported number. I mean, you can
Yeah,
see for
yeah,
yourself.
yeah.
And looking at the numbers which have been reported till at least the February, the early March, I think that growth should sustain. And
Thank you.
you need to know that basically it has a base effect as well, because HDFC Limited got merged in July. So that is not included into the base, right? And that's the reason the credit growth is looking at about 21%. But if you adjust for that, then somewhere it is about 16.5% or so.
And you see that getting maintained.
At least for this year, because you just have 1 month, right?
Correct.
But yeah, next year, as I said, that it will come off. It will come off to at least about 12-13%.
Got it. Right, sir. Thank you.
Yeah, Gopika, you can unmute yourself.
Hi, Anand. I just wanted to know, maybe I missed, what is your outlook on small finance banks? And with this AU merger, do you see them coming as a competition for to other private sector banks?
See, AU basically is merging FinCare Small Finance Bank for 2 to 3 key reasons. One is that they get the PSL benefit, obviously through the microfinance loans. They also get better yield, better margins, and most importantly, is like access to the and PSL is one more reason why basically they did this merger. And the third is that they get access to the Southern India market, where basically FinCare is based out of. But FinCare just getting into the folds of AU, are they really going to give big competition to private sector banks? I mean, large ones? The answer is no, because I think they will take at least about 1 year to integrate. FinCare, they will, they will have to absorb it. I think in the interim, it is going to be a challenging stuff. They can give a competition only once I think they gain scale, and at some point of time they have aspirations to become universal bank. Whenever it happens after 1 year, 2 years, whenever it happens, I think that is the time that you can say, okay, I mean these banks, I mean you will be able to give a tough competition to some of these large private banks. For now, the answer is no. As such, as far as outlook on SFBs is concerned, small finance banks, yes, we remain positive on select, SFBs like Ujjivan, whereas on the AU we have a reduced rating. On the Equitas, again we have we're not that positive because of the valuations and the some kind of asset quality stress showing up into their non-microfinance portfolio as such. Uh, but yeah, broadly, I think Ujjivan is one stock which we like in that space. So we have a mixed view over there. Sector as a whole, SFB, as I said, that the problems that we have talked about in this report, these problems are going to be much more for these SFBs, because again they're short on branches. The perception that we talked about in answer to one of the questions somebody asked, right? What payment bank? I said that SFB also have a similar perception in the mind of the customers. It's not the first choice of bank for these customers. So I think the struggle for deposits for them is going to be much more higher, and that is going to keep their overall cost of funds on a higher side for long time to come.
Sure. And I mean, this is specific on this whole HDFC Bank, that infra, the bonds being classified, given an infra status. What would be the impact of this if RBI has decided not to give the status?
So there is no official comment from HDFC Bank on this. Like they are not confirmed as such. But yeah, if it is true, then basically, to some extent, it increases the reserve requirement for the bank as such. But most of these banks do carry some extra buffers onto their balance sheet in terms of CRR, SLR as such. So it is not really going to impact them immediately. But I think sentimentally, if you look at it, it could be slightly negative if this doesn't get approved by RBI.
Right. And also, have you looked at the whole gold loan market, how that is panning out, and especially after the IFL ban?
See, I mean, we've spoken to a lot of players on the ground. I think gold loan market still remains very lucrative. It is a product which basically is a secured asset product which generates better yields. Asset quality risk are lower. And obviously, the risk-adjusted returns on this portfolio seems to be on a higher side. The problem that we see is specific to some players, and it's not generic in nature. Secondly, in reply to one of the question, I said that particularly related to credit cards, that a push from the players to offer gold loans and not monitoring the end use to some extent, or playing around with the LTVs and so on. Obviously, that is what I think has attracted the RBI's attention. So I think it is more to do with specific players rather than generic in nature. I think this product is good product, and I think a lot of banks are really going to focus on that. We have seen a lot of public sector banks, South-based banks, already focusing on this product in the past, and I think they would continue to do that. Even larger banks now are looking at this product as such. Some kind of regulations is what it required, and some kind of monitoring it was required from RBI. I think they have already done that. They have taken an action to basically set an example. So I think hopefully that would to some extent curb any practices which were not as per the rule books which were happening into the system. I think it will hopefully put the house in order.
So thank you so much.
Thank you, Rupika. Yeah, we have one question from Falaknas. Falaknas, you can unmute yourself.
Falaknas, you had a question.
Not really. Your voice is very feeble.
Am I audible now?
Yeah, better.
I wanted to understand, you spoke about this entire struggle for deposits and those with big banks will have more branches.
Sorry, not able to hear you.
Falaknas, maybe you could type it out if you're facing any mic issues. Maybe you can type it out as a question in the Q&A chat box.
Yeah, sure. Okay.
Yeah, I think there are questions in the chat box. How important are the non-lending subsidiaries like mutual fund, insurance, broking of banks for growth investors? How do you see these accounting for the underlying value of the bank stocks in medium term? This question is not that relevant from our report perspective, which is more about the deposit growth as such. And non-lending subsidiaries, in a way, basically these businesses, basically, as I said, we have talked about in our report about wealth management. So if you look at most of the large banks, I have now in-house wealth management department, and these businesses to some extent complement that, and that is the reason a lot of players like IndusInd Bank and are actually seeking the insurance license as such. Obviously, RBI has its own reservations, but certainly they are looking at these kind of products. If they are the manufacturers of that product, I think that basically gives them more push in terms of these products. But otherwise, basically, they can offer a lot of products through their tie-ups as such. But yes, the entire wealth management business, including insurance distribution, mutual fund, broking distribution, is very important from mobilizing or capturing the retail customer cash flow, I would say, or a transaction flow, and even the investment flow, and in a way to some extent helps the banks in the long run as such. So that is how basically I would look at this question and answer to that, which is more related to our report as such.
So Anand, Falaknas has typed out her question.
In this entire struggle for deposits, how will NBFC small and mid-sized banks fare? See, NBFCs, there are select NBFCs basically who raise deposits, like Bajaj does it, Shriram does it. So there are few deposit taking NBFCs which are there. Now they obviously offer higher rates, and so basically they are not a competition as such. Neither are basically they going to open branches. But one very important thing is that as many of these NBFCs do gain scale, and we have seen that with HDFC Limited, right? Ultimately, RBI prescribed them basically to convert themselves into a bank. So I think something similar is what you want to see also for the large scale NBFCs, where if any point of time, if we enter into a liquidity crisis, I think the NBFCs would suffer, and that is the reason they basically need to secure the liability in the long run. One way is basically to convert themselves into a bank or create a strong deposit franchise the way basically HDFC Limited had created and Bajaj Finance has created, because it gives you a very strong retail deposit flow. But I don't think so they are going to become a competition in their current form as far as banks are concerned. Yeah, does that answer the question?
Yes.
Yeah, Amit, I think we are done with the questions.
Okay. So,
Sorry, can I
yeah.
ask a question?
Yeah.
So two things. One is, some of these banks offer a very high interest rate on savings account. Do you think that has worked? And products like, 811, what is your view? I mean, have these kind of products worked in the market?
See, if you look at, I mean, obviously, if somebody offers a higher interest rate, there are customers who are interest rate sensitive customers, and they would park their deposits into those, banks. But from a larger scheme of things, if you look at larger banks like, HDFC Bank, SBI, Axis, ICICI, they have not offered higher SAR rate as such, and still they are able to mobilize deposits. Uh, so it all depends on either you have a strong deposit flow, you have strong branches, franchisee as such, and which gets you deposits, or you basically offer higher rates and try and mobilize deposits. Now that is what basically Kotak has done. Some of the mid-sized bank like IndusInd Bank has done, RBL, and those banks have done, because they do not have a stronger franchisee. And again, as I said, that these offering higher interest rate basically will help you in the near term to some extent. But once I think you cut rates, I think a lot of these customers go away because these were actually interest rate sensitive customers. And that is what basically I think banks need to think about from longer term perspective, and try and replace the higher interest rate cost through the higher OPEX, because that is a good investment that they will make rather than offering higher interest rates as such from the near term perspective. Second, your question was about Gopika, sorry, I missed.
Products like 811,
Yeah.
where you offer zero balance, those kind of products. I mean, has that worked?
So if you look at, I think 811 in the past obviously had its own success. It's a digital, product that they had, and I think it did well in the earlier phase. Now, if you look at, every other bank is offering some kind of a digital product, right? So it's not a USP which is there anymore as compared to what it used to be there in the past as such. Obviously, it in the entire scheme of things for Kotak, it still has its own advantages as such, and that's the reason they're continuing with their product. But again, as I said, that in our report also we have touched upon this point. Not just 811, but yes, we believe digital is now a hygiene. It is must. You need to have a digital footprint. You need to have digital products to attract deposits. But ultimately, there is no replacement for branches in the overall scheme of things. You need to have branches because branches bring in trust for the customers. Branches are the one basically who are interacting with the customer day in day out. Not only from the deposit perspective, even from the lending perspective, right? If you need a loan as such, and from KYC perspective also, again, it is very, very important that these branches do know the customer on the lending side as well as on the deposit front. Even from collection perspective, you need branches. So the use of branches have undergone a major change, and that is the reason we believe that yes, digital is good to have and must to have, I would say, but there is no replacement for branches. And so product like 811, you need digital products, but along with that, you also need to add branches. And if any bank basically think that they're just going to mobilize deposits through digital footprint or digital products. I think from longer term perspective, certainly they are making a mistake. Somewhere down the line, that's going to hit them hard.
I wanted to.
So this is not specific to Kotak, but I'm just talking in overall scheme of things.
Yeah. Hello.
Yeah.
You're not giving any perspective on how much the deposit rates will go up. We are saying that there will be a scramble for retail deposits, and you're saying that those with banks will look at opening branches, and those with who have already have that branch expansion in place would fare better. But in the medium term, short term, medium term, would the deposit rates go up by 100 basis points, 200 basis points? Would you throw some light on that?
So, I clearly said that you have to break it. I mean, you have to break down the question into two parts. One is near term and long term, or a short term and long term. So, short term, if you look at deposit rates, would have largely peaked. Maybe either they would remain at the current levels because most of the banks have already raised the deposit rates, or it would go up slightly bit. And depending on the liquidity situation, it might even come down. What we talked about from a longer term perspective on the retail deposit scramble, we are saying that from a normal deposit rate cycle perspective, if banks do not add branches, if they do not incur that OPEX, then obviously the retail deposit flow will be slower. And then to accelerate that retail deposit flow, I mean, they will have to incur cost through offering higher interest rates. So you have a choice. Either you offer higher interest rates or basically you incur OPEX through opening more branches, or you have both the strategies in place. You offer slightly higher interest rate and then you also open additional branches as such. And that is how basically you go about it. Now, it's not that basically the retail deposit rates are going to go up. I'm saying that when basically the cycle turns down, say for instance, maybe 6 months, 9 months, 12 months, whenever it happens, if these issues are not addressed, it will not go back to the level where it started. For example, if deposit rates were just about 6%, I'm just talking about the 1 year retail TD. For some banks, it was even 5.5%, right? 5.5 to 6%. If it is now somewhere about 7 quarter as such, basically it might not go to 5.5, 6%. They might, even if the rates fall in the system, they might offer slightly higher rates than what they used to offer in a benign or a very good liquidity scenario. So that is what basically I mean it. Now you can't put a number to that. Retail deposits will be higher by 50 basis point, 25 basis point, 100 basis point. It all depends on the bank's individual strategy. As such, it's not a systemic problem. Again, as I said, there are some banks who are better off. Obviously, they will not offer higher interest rate because they have invested into branches. So obviously, that is impacting their ROA at this current point of time. But certainly, they will reap the benefit in the long run. As such, so you can't put a number to that. Yeah, Falkness, that answers your question.
Yes, sir. Thank you.
Sure. Yeah, I mean, I think we do not have any further questions, right? Amit, can we close the session? Yeah, guys, I think we are done with all the questions. If you have further questions, you can always call me. Amit can share my number. And with that, we will end the call. Thank you, guys.